time has come. The preparation has been completed. And here we are in front of everybody. Welcome to the show, Shameem.
Thank you, Brett. So excited to be here with you today.
And the listeners have no idea how much we've prepared for this conversation today, huh?
Yeah, this is the most prepared I've been for a podcast.
That's awesome. That's awesome. So you're out on the road right now. You're actually traveling with your setup as well. And I want to jump into our conversation. I'm so excited to talk about a few of these topics, like fund-to-fund type investments, just financial education, the importance of it overall, the financial advisor world. But all of this relates to the listeners today because guess what? Shameem is a physician, right? Tell us a little bit about your medical career and where you're at currently.
Yeah, I've been an ER physician for 25 years now, pretty much. And that's my practicing years. I've graduated medical school even before that. So, you have your medical school residency in addition to that. So I've been full-time practicing physician and really just got into real estate a couple of years ago. And or maybe a little bit more than that, and just started learning about the different ways to invest in commercial real estate, and that's kind of what I'm doing. And then I started creating the little bit of a network through my physician colleagues, and then created the Doctor Investor, which is my company. And our goal is to really educate and inform physicians about the benefits of alternative investments and how to go about them. You need to build something more robust that has many levers. There is the stock market, and then there should be some form of let's start thinking, how do you want to create passive income? Because you're going to get old someday. Or you might get hurt. You might, have some other reason. You need to start thinking, how are you going to build passive income? And it may not be real estate for you. Think of something else. Create a business, whatever. Sell something. I don't know. Whatever is your passion in life. I don't think that everybody needs to do real estate. It's just one of those things that does work most of the time. So, but, it could be something else. But it's so important to start thinking outside the box. It's wonderful you've gotten your education and you're a doctor, and that's a great job, but always have something else, and I think that's something I was not taught or encouraged to do by financial planners or others. So think about passive income and how you want to create that, and think outside the stock market. There's no harm in putting a small percentage of your portfolio in alternative investments, whether that's real estate or oil and gas or some other private equity. Start learning about it. Just put like 10%, put like 50 grand and just 50 grand to alternative investments. You don't have to keep adding. You certainly don't have to move your entire portfolio over, but just put a small amount there and let that roll over, exit that deal, put it in the next deal, try different things. And that's how you're going to learn. You're going to understand how these things work. And then you're going to figure out what works for you. And then you're going to feel so much more empowered to take control of your financial future. The physician who's been 20 years in the practice versus 1 year in the practice, it's a whole different person, right? And so experience teaches you. Yep. And then on top of that, like you said, they don't have that sense of responsibility and duty. I know they have the fiduciary duty and things like that nowadays, but, is that truly at the same level as what a physician is doing? And I think we don't, especially as physicians, get that. We think everybody's like us. Like, oh, of course they're a good guy, and of course they were trying to do the right thing because they said they were. Right. And so I think, and I'm not saying we shouldn't trust others. I'm a very trusting person, and I get along with everyone pretty easily. But I think that, we need to be a little bit wiser. It's not like everybody's out there taking the Hippocratic oath to first do no harm and then make sure that you're okay first. Yeah. And not everybody's going through that degree of extensive education and experience before they handle your money. They have a certain formula, and they're just applying that formula. Most of your money is just in indexed funds. It's not like especially general financial planners, maybe Edward Jones and people like that, they're trying to pick stocks, which also may not be a good idea. But, they're just, there's not a lot of thought and care put into how they're managing those things. And so I think you're right. And I think definitely you are your best custodian and steward of your anything, whether it's your health, whether it's your wealth. When you pay attention to something, that's when things, when it happens in your favor, when you can actually make a difference, when you start paying attention to something. It's just like if you went to a doctor and said, hey, I'm overweight and I've got a bad heart, fix it for me. It's not going to happen, right? I mean, they can tell you something and they can help give you advice, they can give you medication, but if you don't take that action, if you don't start paying attention to your health, and you don't watch what you eat and exercise and do all those difficult tasks, which sound really boring and unpleasant, you're not going to make a difference in your own health. And it's the same thing with your wealth. If you don't do the boring tasks of looking at your retirement accounts and checking your budget and figuring out how all this works, you're not going to be able to make the impact you want on your wealth.
You've got to track it. If you're not going to track it, then you have no idea what it is. And that may be like step number one of caring more about your money than anybody else.
I heard a great quote. I'm sorry to interrupt you, but it's going to slip my mind. I heard Cody Sanchez. I don't know if you follow her. She's kind of like this wild businesswoman. She's very active on social media, and I saw one of her reels today. And she said when she was younger, she said it's so important to be in the room with people who are, in her case, she was talking about people who are making more money than you are, because they see things so differently. And she said she encountered someone who asked her about how much money she makes, how much does she spend, how much does she earn down to the dollar per month, and she didn't have the answer. And so that guy said money, or maybe wealth, is a cruel mistress. If you don't pay attention to her, she will leave you. I thought that was a really good, catchy phrase. I didn't really plan to do fund of funds. I was going to become more active investor or co-GP, et cetera, like these different types of things people do. However, it just so happened that as I was even considering, which way I wanted to go, the sponsor that I met and I really wanted to work with had only this option, was that you can be a limited partner, you can't be a co-GP on their team. So that's why I did the fund of funds model. And what happens there is because, like I said, most minimum investments for syndications is going to be $50,000. And they will have a certain profit share with the sponsor at the end of the deal. In this case, it was like 50-50, let's say, because it was a development project. So 50% of profit would go to the developer, 50% would go to that investor who invested $50,000. And this is after 5 years, right? So it's at the exit. So then what you can do as a fund is you say, hey, I'm going to bring in $1 million. So I want a better profit split because I'm giving you one investor, this fund, with $1 million. So they will give you, willingly, a better profit share because it reduces the work for them. It reduces the work and it gives, because they'd prefer to have fewer investors with large checks rather than multiple investors with smaller checks. So they will give you a better profit share. So instead of 50-50, they might give you 70-30. And so now you have that spread of 20 points to then split between your fund investors and the fund manager, which would be somebody like myself. So I could take 10% and pass off the remainder 10%. So now my investors are getting an extra 10% by going through the fund than they would have gotten had they gone to the sponsor directly. So that's essentially the business model, is like saying, okay, we as a group are going to become a large investor, and then we have more power to negotiate a better return. And also, if you can really build that fund to, let's say, you're $5 million or you're bringing in half of the equity for the whole deal, you would have a lot more power to even be, the whole fund could be a co-GP, or it could have more voting rights or other rights negotiated because, you're bringing in a lot of money. The development projects really don't produce any cash return up front, right? Because there's nothing there. There's like land. So there's nothing you can charge rent on or anything, right? So it's really a long-term game. And so that's why we created the MedInvest Income Fund as a cash flow option. And this money is also being invested in real estate, but it's what we would call a preferred return. So we're offering a 10% preferred return up front instead of accruing that return. So if somebody wants a cash flow option, this would be a complement to the other syndications we have, because those are more long-term holds.
And in that scenario, I think that the setup was in the development, the builder is actually paying this just like a loan, where they would be paying interest on the loan.
Right. It could be that. It could be invested in multifamily. It could be invested in single family homes. It could generate that return from a variety of ways. There's no restriction on that fund. But yes, if we loaned it to a developer, he would be paying he could be paying it as debt too. But we don't call it debt, because if you are earning interest on debt, you have to pay income tax on that earning. So what we do is we don't define it that way. We consider it financing, but not actually a form of debt. So that way, when we do return those distributions to our investors, that's considered return of capital, and it's not taxed as income tax. So that was the whole purpose of creating it this way, because then it's another type of syndication. It is equity it's not actually debt. It's actually truly equity, and then preferred return is what it really is. So, and usually preferred return is accrued over time and paid to you at the end. In this case, it's being paid ongoing.